Welcome, I'm Catherine Magana here with Vince Stefano and Greg Carroll, where we're here to provide you insights on the markets, planning, and much more. Today is June 11th, 2026, and here we are a week later, and the U.S. and Iran are still at war.
Getting hot again.
Right? And I saw the
Getting
U.S. struck Iran this morning, so the markets are up a little bit because of that, but every day is a new day. We actually heard from the PPI came in, which is the producer
Price
index came in a little bit higher, so that's came in 1.1% higher than, and then the CPI came in, which is the consumer price index. And that came in at 4.2%. I think we were kind of expecting, obviously, over time that was going to come up. But it was interesting as I see that and I look at where we're at with some of the shorter term interest rates. I mean, now inflation is higher than some of the short term fixed income that's out there. And that's pretty common over time. But the last few years, we haven't seen that. But that is common where some of those short term fixed income rates don't keep up with inflation. And so kind of looking at where we're at, so as of yesterday's close, yesterday was June 10th, the Dow Jones over the last week was down, so we ended up at 3.86 as of yesterday. The NASDAQ had the biggest drop over the last week. It was at 8.29. It was actually down over 7% over last week.
Had a little flush out on Friday last week.
Did. So. And the S&P 500 was at 6.16, and that was down almost 4% from last week. And the Russell 2000 hasn't moved around too much. It's at 14.25. It is down over 2%. And then looking at kind of the 10-year Treasury, it's at 4.54, which is a little bit higher than it was last week. But that's obviously subject to change as well. So obviously, the markets have been a little volatile this last week, and so looking kind of at where we're at with some of the different indexes. So looking at the kind of the fixed income area, the 1-year CD is now at 4.05, and the 1-year Treasury is at 4.039. So the Treasuries have come up a little bit, pretty comparable with the CD rates right now, but the 1-year CD really didn't change too much over the last week. And then mortgage rates are at 30 years at 6.55, and the 15 is 5.92. So not too much change over the last week there as well. But still looking at kind of the probability of a rate cut, it does look like in June we don't expect any changes, but potentially between now and the end of the year there is a 70% chance of at least a 25 basis point increase is what we're looking at now. So.
And you know, the inflation issue is kind of interesting because, Milton Friedman once said that inflation is ultimately caused by too much money chasing too few goods. But I don't think that's necessarily the scenario we're in right now. It's because oil and gas is up 50% since the war started. Excuse me. So, high energy prices can definitely elevate the CPI like it has been for a little while, but until that really gets ingrained in the economy, the high oil prices in and of themselves are not going to have a sustained effect on higher inflation, which means, maybe they don't hike this year, maybe they don't lower rates either. But I think the second half is going to be a much different. We're going to have a much different perspective on the economy. So it'll be interesting to see how that plays out. But I know all the, the Fed meetings and stuff, or the numbers you're talking about there, that all they're talking about is a quarter-point hike sometime.
Mm-hmm. Yeah.
And I've heard, the talking heads, on all of the financial news channels have talked about inflation. And the current inflation right now is war related. I mean, it's as simple as that. It's as simple as that. And it's all oil driven, as you said.
Yeah.
Gas, jet fuel, agricultural fertilizers, they're causing a spike in food prices. And, as a result, Catherine, you mentioned the CPI and other, and those are up to 3-year highs right now. Mm-hmm. And, it's going to keep the Fed on hold. But the interesting point is right now, you've got the 10-year last I looked, the 10-year Treasury I think was around 4.5%, somewhere around there. The 30-year was about a little over 5%, maybe 5.02 or something. But until the 10-year hits 5 and the 30-year hits 5.5%, there's still a strong bias towards owning equity. So the stock market is kind of looking through some of this, and it's factoring in possibly lower inflation going forward if we can get out of this situation in a relatively short period of time. What was interesting, the producer price index was up, and that's, the inflation before it reaches consumers. Wholesale gasoline prices up 28% April to May. That's huge.
That's huge.
But again, war related.
Yeah.
Inflation is, stubbornly staying above 2%, and that's the Fed's target rate. And so there's probably going to be no change in the interest rates going forward. But what's also interesting is food, clothing, housing prices are going up more slowly than energy and agricultural products.
Right.
And what we're seeing is on the flip side of that, hourly earnings are down a little bit. So that means that the purchasing power of households has declined a little bit. However, the interesting thing is, because of the stock market gains, there's been a soaring household wealth that's been supporting spending. So I think you were mentioning something about spending, and I was too much money chasing too few goods, and you're
Right.
like, well, wait a minute, where is it all coming from? Well, it's not coming from wages; it's coming from the soaring stock market.
But also the tax refunds were
and
larger
I was just gonna,
yeah.
you just mentioned. I was just gonna mention that.
Got it.
I was just gonna mention that because what I'm also hearing from a lot of the conference calls that we've heard recently from a lot of companies is that U.S. business investment is outpacing the overall growth in the economy. So businesses are growing much faster, and it's driven by AI, and it's driven by tax incentives
Businesses
for business.
are growing faster. You mean their spending is growing faster?
Their growth, the overall growth
Okay.
of revenue is growing much faster than the overall economy. And again,
Right.
it's AI and
Right.
it's tax increase or decreases incentives that you just
Yep.
talked about. The other thing is AI should, if it does what it's supposed to do, increase long-term productivity. And as a result, you should get an economic expansion that increases in duration. And bull markets, because of increase in productivity, typically last a lot longer. So again, you've got a lot of cross currents because of what's going on in the Mideast, and we're seeing that in the stock market because we're seeing very narrow gains in certain sectors. And so it continues to be the chips, the connectivity, some of the memory stocks that continue to drive the indices that you're talking about. So again, I think we're in one of those areas of the market where investors want to be there. There's a fear of missing out, but there's also a fear that they're buying at the top. So I think you got to be really cautious and stay very, very selective on the stocks you want to own right now.
Yeah, I think the Mag 7 acronym, all those stocks are actually negative for the year, and many clients are way overweighted in that area. But now they got a new one called Mangoes or something. Has something to do with the big IPO tomorrow that everybody's been talking about, and whether it's going to be a good thing or a bad thing. And I know there's been a lot of talk about, surprisingly, that this is the world's largest IPO, and only in this country can people actually hate that idea, where most countries would really love to have the world's largest company initial public offering. So people have been concerned about this being put in their 401ks. They don't want to be the outlet for, the insiders that maybe have made a whole ton of money, which is understandable. But
And just to clarify, how it would be put in the 401k is potentially through some of the indexes
Through
or
the
mutual
index
or
funds.
things that you own
but
potentially.
S&P has said they're not going to put it in their funds. So a lot of people own the S&P 500, right? It's not going to be in there. Their usual criteria
But
is.
doesn't it have to go in at a certain point? I mean,
Well, after 12 months and 4 quarters of positive earnings before they can go into the S&P.
gotcha.
The NASDAQ has tweak their criteria, and they will start putting some of that in their indexes, over the next couple of weeks. But the QQQs, the percentage, that's the kind of the NASDAQ index that a lot of people might own in their 401ks. That whole index is about 1.7 trillion. The S&P 500 is about 20 trillion. So you're going to get a very, very, very small piece if you own some sort of NASDAQ high growth index in your fund, in your 401k. So the impact to 401ks, I don't think anybody should really be worried about if you don't like it. And if you do like it, you're really not going to have much exposure to it through that either. So it's kind of a non-event with the 401ks. There's been a lot of media attention on it, but it's really a non-event.
So, Vince, going back to your conversation about investor spending, and obviously the markets have helped. And so it was interesting. We spoke with a client this week who had allocated some money. They were building a property, and we had allocated some money in their plan. And now here we are a few years later, and there's some additional cost and projects that are going along with this where potentially they are going to need some additional funding, and that's something we're factoring into the plan. But one of the reasons why they're able to do all this is because over the last several years, based on their allocation of how they're invested, their money has grown well for them. And so at this point, and based on her age and some other variables, she can actually do this because it makes sense financially. But I think, like you mentioned, there was some wind at the back because of some equity growth that took place over the last few years. So once again, that's kind of case by case. It's not, for everybody. Everyone's a little different with their risk temperament as well. And then looking at, we also had another client we talked to this week, and what they're looking at is potentially some partial Roth conversions. And once again, we always talk about this is it's not for everybody. You kind of have to look at, what's your current income, what do we forecast later down the line for your potential requirement of distributions, and does it make sense? And for this particular case, it does make sense. We're going to do some pretty aggressive partial conversions while they're still young and have some tax brackets to reach and to benefit them.
The tax planning with IRAs and 401ks and Roths is really getting to be quite complicated.
Yeah.
There's a lot of variables there, and the income and how close they are to retirement. But
correct. So, and once again, like I think we've talked about in the past, is there IRMA, is there Social Security, is there Medicare? What are all?
So many variables.
They're young
so
enough
many
where
variables.
that doesn't affect them. But just once again, it's even if you read it in the headlines, it doesn't mean it makes sense for you. You really have to look at the numbers.
Right.
And then, as Rachel's not here today, but she would probably say is make sure you get your estimated taxes in.
That's Monday, right?
It is.
So Monday.
Yeah. So we're already the middle of June, so those taxes are due June 15th. And then we actually had another conversation this week from a client that was listening to our podcast, and they had some questions on some real estate with the family and the tax consequences. So Rachel and I are reviewing that with them. And so once again, if you have any specific questions or want us to look at anything, that's what we're here for. It's better to be proactive than reactive. And so obviously that's, we're here to walk through that with you along the way. So it's kind of where we're at. I know we have, the markets are fluctuating, and so I guess I'll share where we're at with the fear and greed index.
Fear and greed. Yes. Oh, yes. Yeah, that
Okay.
thing is
Yes.
fluctuating like crazy.
So as of this morning, we are at 27, which is fear. So,
Wow.
which is not, so that's.
Man, wasn't it 60 something last week?
So we've.
Well, you know what? With all the high tech stuff taking the beating,
Yeah, that's
in the
true.
last week, I mean, people, they're concentrated. They're not looking at things. I don't know if you saw, there was a gas station chain. I think they're mostly in the Midwest and the East. It was up like 15% on earnings yesterday. There's a lot of companies besides, the Mag 7 and the conductor areas of the market. So, there's a lot of different areas to take a look at.
When you see the economy growing nicely, it does lift a lot of boats, and it's not
Right.
just technology.
Right.
I mean, this market has really broadened out over the last 3 to 4 months as people have pared down some of the Mag 7 and the bigger tech names. Now, granted, that's where all of the action is, and That's
All
where
the news
all the
and-
innovation, all the news. Everybody's talking about, tech, AI, the whole thing. But, you've got a lot of companies in America that are boring companies, at least
that have done quite
that
well.
have done very, very well. And as the market keeps moving up, these companies, earnings are doing well, revenue's growing, and with all of what's going on with the increase of manufacturing and construction and other types of basic industries in the United States, I think you're right. I think you're going to see a lot of non-tech companies over the next, year to 18 months do well. And now they may be considered value companies. I don't know.
I'm not sure how they draw the line anymore.
Because people, draw the line like crazy. Because I see Mag 7 companies in value mutual funds and ETFs, and I'm
Right.
like, wait a minute, how
Right.
is that? There is a lot of, I guess, flipping of, between the different asset classes like that, between value and growth and the like. But, basic, these industries are going to do well. And I think as long as the economy continues to stay strong, it doesn't look like it's going to be recessionary. It doesn't look like you're going to have stagflation. And I think the Fed's going to stay on hold, and the market's going to not react negatively to that. I just don't see them worrying right now about a hike in interest rates yet.
Mm-hmm.
And I'll put some caution out there yet, but.
Depends
and again,
what happens over the weekend. And
Yeah,
I
you
know
don't
every
know.
day it's like, wait a minute.
Yeah, you don't know.
What's going on? What's
But
happening
anyway,
today?
I just think that I just think that with inflation where it is now, once this crisis does end, I think you're going to see inflation come down, and I think again that's going to be very beneficial for a lot of industries and
Right.
stocks especially.
All right. Well, I think that concludes today's session. So thank you for joining us, and we'll see you next week.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.